Good morning. Cap rate expansion and contraction explained simply. And if you invest in commercial real estate in Houston, Katy, Fulshire, or West Houston, you must understand one concept, and that's cap rate expansion and its sister, cap rate contraction. They directly determine your property value, even if your NOI never changes. So let's break this down simply. First, what is a cap rate? Well, the capitalization rate or cap rate. The formula for that is your net operating income divided by your property value. And if a property, say, produces 100,000 in net operating income and trades at about an 8% cap rate, you divide that 100,000 by the zero point zero 0.08 to get a value of about 1.25 million. So cap rate is essentially the market's required return for that particular asset type at that particular moment in time. So what is cap rate expansion? Well, cap rate expansions means that cap rates go up. And when cap rates go up, property values go down. So let's look at an example. It always helps to have numbers. Same example with an NOI of 100,000. And if the cap rate moves from 8 to 9%, then that new value is the 100,000 divided by 0.09, which is like 1.1 mil. So you just lost 138,000 in value without losing a single tenant or changing anything about the property. So why does cap rate expansion happen? Well, often because of rising interest rates or tighter lending standards, but also increased risk perception or economic uncertainty, or if there's oversupply in that specific asset class that you're looking at. So we saw this nationally after rate hikes began in 2022 and everybody's debt costs rose. And what happened is buyers demanded higher yields. So what is cap rate contraction? Well, it's the vice versa. Cap rate contraction means that cap rates go down. And when cap rates go down, property values go up. So it's a reverse relationship there. So let's go back to the example from earlier and say you have 100,000 in NOI, but your cap rate is no longer 8, it's now 7%. So 100,000 divided by 0.07 is roughly 1.43 million. So that's nearly 180,000 in a value creation without increasing the net operating income. So you may be asking, why does cap rate contraction happen? Well, it's likely because of falling interest rates or abundant capital or strong investor demand, or if there's institutional buying pressure, but also if there's stable tenant credits profiles. And Houston Industrial during peak logistics expansion is a good example of how cap rates compressed significantly just due to demand itself. So why does this matter in 2026 is something you may be wondering. What I'm saying here is we're entering a period of price discovery. And in West Houston and Katy, industrial remains resilient but selective. And retail with strong tenant credit is holding up strong. Office remains under pressure, although in suburban markets it's actually a little bit better than a central business district. And multifamily is recalibrating due to supply issues or lack of supply being delivered. So the direction of cap rates will really determine whether it's time to sell or whether it's time to refinance or whether you want to hold the property for a long-term hold. It also can dictate how you're going to structure your exit. And this is where strategy beats speculation. So cap rate is not the whole story. And here's something that sophisticated investors have grown to understand. And cap rate is a snapshot. It's like a pay stub. It's whatever it is at that exact moment. And it does not account for, say, future net operating income growth or your lease rollover risk or your tenant credit quality or your debt structure or any interest-only periods you have built into your financing or prepayment penalties or what you and your investor group is looking to make an eternal rate of return over the hold period. And in many cases, financing structure has more impact than entry cap rates. So let's talk about how smart investors can protect themselves against cap rate expansion. So buy with margin, but don't over leverage. Lock long-term fixed rate debt if available, and focus on durable submarkets. So think FM 1463, I-10 West, Grand Parkway corridors, and prioritize tenant quality over yield. And also underwrite your exit cap assumptions conservatively. So if you're investing in Houston commercial real estate, underwriting your exit cap 50 to 100 basis points higher than what your entry cap is, that's disciplined risk management and will set yourself up for success by doing so. So here's the takeaway for the day. Cap rate expansion and contraction are not abstract concepts. What they are wealth creators, but they're also wealth destroyers and eroders. And understanding them allows you to time your acquisitions intelligently, but also to avoid emotional selling, and also to structure your debt properly and protect your downside risk. And if you own or are considering buying commercial real estate in Katy, Fulshire, or West Houston, understanding cap rate mechanics is non-negotiable. And that, my friends, is it for the day. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. I'd love to talk to you further. Take care.